we have a little bit more time. So what I'll do is, besides these actual moves, let's look at the what the implied volatility did in Microsoft after reporting earnings. And this looks at when we look at implied volatility, we have to kind of define what we're tracking, because we can't really look at implied volatility of an option 2 days to go and then compare it to an option that had 10 days to go, or compare it to an option that had 30 days to go, because the implied volatility structure is different as we go out in time. And also we have to define, well, what strikes are we looking at, because we can't compare not the money implied volatility to a deep out of the money option implied volatility, because these are they tend to have and trade at different implied vols relative to each other, right? It's not always it's not a straight volatility across the board. The implied volatilities differ. So here we're going to define it as we're looking at the 30-day implied volatility at the money options. Okay, so that's what it's a benchmark of a 30-day constant maturity. And how did that implied volatility tend to do? So here we see that on average, the implied volatility the day after earnings in the 30-day IV decreased by 23%. Right, so the day before earnings announcements, it was 34.2 on average. Then the day after announcements, 26.4. You could see the drop there. And we go out a little bit further to see if this continues to drop, stay the same, tend to go back up, because the next day could be overdone, right? Because what happens is you have a lot of selling of options the next day because people are exiting their positions, or now sellers of options could be feel more confident selling because that event, that uncertainty is gone. So does it tend to be overdone, or does it tend to go lower as time goes on? Like, what is the deal there? How does that look?